Market performance today, it's bucked the trend of the last few sessions. What happened?
Well, there was a bit of a positive upturn. I think now, when the market's been down for some days, then you get another set of investors thinking that they can get good deals, thinking that the market has bottomed out. So I think that's what we've seen today, because we've had a bearish trend now for the past few days, and then we're up almost 1% on the day's trading. So that's what we're seeing, some more optimism now that there's good value for the stocks.
All right, and it's particularly a story of the banking stocks?
Well, it's the banking stocks that have had a bear run, really. Even all the banks generally since the beginning of this month, there's been quite some pressure on them. Maybe it was profit taking from the positions of earlier months, we're not too sure. But for today, there's been a little bit of pickup. A couple of the banking stocks are up, and about half the stocks on the equities are also up. So some positive sentiment coming through today.
All right, expectations for the Treasury Bill auctions that we're going to see today?
Well, there's a bit more on offer. We have about an extra 15 billion, two maturities, 91 days, 182 days. We expect yields may trend slightly upwards, just slightly. I say this because, money is opportunistic. At the moment, money market rates have been pretty high. So there's been opportunities for higher yields in the overnight markets and in the interbank markets than in going into longer tenor securities. That said, there's still interest in the long securities, because then at least you've locked in, you can predict your income over the next 3 to 6 months, but maybe a slight improvement, just slight.
I mean, just talking about what we're likely to see on the bond markets, as well as because we've just seen in the last week the inflation numbers coming out not quite what was expected. Have they started to have any bearing on sentiment?
Well, sentiment in the last week, again, it has been opportunistic. What has happened, the bond market tends to be very busy at the shorter end, because that's where there's a lot of interest, there's a lot of liquidity. But because of the fact that the overnight markets rates have been at pretty much their highest levels year to date, we're talking about close to 14%. So there's been less bond activity up till maybe yesterday or so, and there's been more interest in taking advantage of those very short rates in the overnight market, 13.5. Today they've gone down. They've lost about 200 basis points between the close of business on Monday and today. So today we're looking more at 11.5%. And now that there's some liquidity in the system, we'll probably see an uptake in the bond markets going over into the next few days.
What are we likely to see by way of interest rates having a bearing on the market, easing off slightly because of statutory allocations? How does that work?
Okay, what happens is that government has recurrent expenditures every month. These are pretty high. They have a lot of impact on the amount of liquidity available in the system, and they tend to come in around this time. Anytime between the 16th and the 21st of each month, that's when you find government spending, and then that's when markets tend to ease a bit. So we're seeing those flows again, this from Monday into today, and possibly till the end of the week. There's money coming in. For those go to the states and the local governments, and generally interest rates have gone down just a little bit in response.
Let's talk about the exchange rate, above 156 naira, but looking a little bit better than we've seen in some sessions over the last few weeks.
Well, we've actually had 3 losing sessions, Lerato. Devaluation, we've had 3 successive devaluations, significant ones, all above 20 kobo, 21 kobo last week, 21 kobo on Monday, and 24 kobo today. We've seen excessive demand. We've seen excess of demand over supply, again, 3 consecutive weeks. The central bank has upped the amount that they've put on offer. Usually we're looking at 300 million, but we've had 400 million twice this week. And even with that, there's still been excess demand of about 80 million. So it seems that, could be mid-year activity, or it could be just people getting nervous again. Not too likely, more like mid-year activity is picking up. But there's been quite a lot of demand this week.
All right, just explain to us what's driving this dollar demand, as you're saying, media activity and other factors, because we had been told that post-elections and the situation settling down, people shouldn't be feeling jittery and people shouldn't be taking long dollar positions.
I agree with you, which is why I say it's probably more of the mid-year cycle. And again, we're through the elections now, they're far behind us. We have assurance that, that rates are going to be stable to the end of the year. Not only that, we've seen some increase in the level of our general reserves, and that always helps to calm fears. So I don't think there's so much of a panic. I think it's just we're in the middle of the year. Everybody's producing at full capacity, so there's been quite a lot of demand. However, I have to say the interbank market has been calm. a little bit of appreciation from the beginning of the week till today, about 156.50, like you said. So quite calm and not too far from the CBN levels.
All right, and very briefly and finally, Kubi, we're heading into the second half of the year, or probably which is there already, and there is a sense that we need to be able to gauge how this market is going to perform, both on the fixed income and money market side and then the equity side. What do you think?
Well, equities will probably, a lot will depend on how the banking sector resolves itself. Manufacturing stocks, they tend to be stable, you know, there's a lot of value in them, but because of the volatility we've seen in banking, a lot depends on that. If if the next 1 to 2 months things seem to be working out smoothly, then we'll see an appreciation in the equity market. But we have seen nervousness in the past from the beginning of this month, which is why there's been such a bear run. So we're hoping to get past that, and then there should be some improvement on the equity side. For fixed income, interest rates are likely to still go up. Yields are likely to still go up. That's what we see, because of course in the process of defending the currency, there's likely to be a bit of a drag. Again, inflation has been quite high. We're looking at 12%. We're trying to get inflation down to single digits. So it looks like interest rates will likely rise through to the third quarter at least.